Hello and welcome to Leviathan News. I am your host, Sam McCullough, and I'm joined by trusty co-host, DeFi Advisor. How are you?
I'm good, sir. What's up? How was your weekend?
It was great. Yeah, very nice. Today, we are going to be talking about the compound finance governance attack and a sprinkling of Trump in the end. But before we get there, let's talk about our sponsor. And so, are you curious about restaking? Yield Nest offers a new approach to potentially boost your ETH returns. As a liquid restaking protocol, Yield Nest aims to simplify restaking through its YNETH token. So you can deposit your ETH and then get an exposure to a basket of AVSs, actively validated services. And that is going to provide additional yield on top of just your vanilla staking. So they have a lot of baskets that they're going to have. But right now they have YNETH, and it's going to be liquid soon. So the Yield Nest strategy does involve some complexities and risks, and it is an investment. So if you are interested in checking it out, and we do like Yield Nest here, we think they're great, go over and check it out. We have a link in the show notes below, and you can learn more at Yield Nest's website at yieldnest.finance. And they're also on Twitter at yieldnest.fi. All right. So let's get back to Compound, which kind of a wild story, kind of not. I mean, where's your thoughts on Compound right now? They've kind of faded a little bit. I guess people use them. Aave has become the dominant player. But
yeah, in general, I don't hear about Compound anymore, and I don't really know nothing about it. But ever since yesterday night, my time, the whole timeline was about that compound stuff with Humpy and him taking over control of the funds or whatever's going on.
So I think that the Compound story is interesting because they are one of the oldest. I mean, they were the first to essentially issue a token through liquidity mining way back in the day. This is a project of Robert Leshner's. They were one of the first places to essentially take loans on your crypto. And they just have a very solid name. They're blue chip. I don't know who you can get more blue chip than Compound. And we also have another guest, Mr. Bryan Colligan. How are you doing, sir? Welcome to the stream.
Doing well.
Hello.
Doing well.
We were just running over the kind of blue blood nature of Compound as the crypto OG of OGs when it comes to DeFi.
It's an interesting scenario what's going on. Is it a feature or is it a bug? I think that it's working as we've had a lot of conversations over the last 24 hours internally. By the way, Bryan Colligan, founder of Alpha Growth, running the Compound Growth Program. What has happened? We've been on the lookout for about 6-7 months, and we've been watching this thing go on. And 24 hours before the proposal voting period ended, there was about 200,000 votes. We had 580,000 negative votes, and weren't too necessarily worried about the situation because we've been this is like the third or fourth time this has happened. And went to bed with 30 minutes left. I got a phone call. Hey, they're winning the proposal. Like, what? How's that going on? Like, how's this even happening? And then we try to rally the troops within a matter of 30 minutes. And one of the negative aspects of decentralization is it's slow, and DAOs are slow, can be slow to respond.
Let me just run through the backstory here.
Yeah,
because I think it's a little interesting, right? So this was a proposal that was put through by Humpy, and he's got a token called the gold token. And so the initial proposal was to this is the third or fourth one that he's done so far. The initial one was to grant 92,000 comp. And that was submitted without prior discussion. Apparently, you found Compound security guy found it and was able to highlight it during that time period. Apparently, not very many people commented or raised a storm at this point, seeing this social attack that was happening. So Humpy, the person who proposed it, acknowledged, like said, okay, you know, I see that there's some issues here. So he canceled the first proposal. Then he submitted another one. That just got a couple of comments as well too. That proposal failed. And then he's come back for this last one, which saw him increase the amount of comp from 92,000 to 500,000. And it has passed. And so, Bryan, what exactly does this vote do?
Okay, so it effectively takes about 1/3 of the comp in the governor treasury, which is about 500K comp. It puts it into a treasury contract that, you know, there's still security audit concerns over that and kind of like what effectively it does. But what it looks like it does on the surface is it mints another token called gold comp, which starts to become a yield bearing asset. The yield is generated through what we think, and we haven't tested it all completely out, through basically volatility, like creating LP pools with the token with DAI and ETH, and then through that volatility of the comp token, generating yield back to the gold comp holders on its surface. I mean, we you know, hasn't been fully audited, it hasn't been fully, like, every single part of the contract hasn't been fully gone through. And I mean, that's one of the risks too. The other risk is that this vault also maintains governance rights. So the holders of the multi-sig that hold this vault contract retain the governance rights. So currently, Humpy and the Golden Boys would now own 1.1 million of votes of comp, which by far makes them the largest delegate, with the second largest delegate being A16Z with 260,000 votes. So, you know, admittedly, I think we're seeing the end of like this really kind of weird scenario of like late stage Daoism. I'm trying to call it. Let's like not late stage capital, but late stage Daoism. When the founders are kind of gone and the major token holders no longer have enough economic viability and they divest from a protocol, how does the protocol continue to go? And through 3 weeks ago, we set up a governance working group just trying to strategically figure out how to prevent something like this from happening. We just haven't moved it fast enough. And then on the other side, I would say is that Humpy has a point. There should be some yield bearing aspect to a token if you want enough attention around a token. A token just as governance may not have enough financial utility for people to care, and which is an interesting point. And so that's something that was kind of part of our mandate. We were looking at that later down the line as how do we add more liquidity to comp token? How do we earn some yield bearing aspects? Having a staked version, there's like 3 or 4 different vendors we're already talking to about potentially doing that with, to have a yield bearing asset to the comp token, but it's not something that was immediate.
So this, how would governance be controlled? So essentially, he's creating a LSD for comp, where the comp is retained inside of some multi-sig, and then a LSD is created on top of the comp token, which then he's going to pair inside of balancer. I think it's like a 99-to-1 balancer LP, which essentially like creates no impermanent loss, but does create some trading volume. When you're looking at the and then also Humpy does have significant like balancer incentives that he can control to direct towards that pool as well too. So when you're looking at the voting, right? I guess my question is like, where are all the other voters?
That's a great question. They're not there. Like I said, the majority of the original VC and the founders have divested, right? And so we've noticed this, we've understood this for a while. When Alpha Growth running the compound growth program came in, there was 2 major voters that kind of, and there was like 8 to 16 kind of delegated voters. Those were Polychain and A16Z. I don't want to throw blame, and I'm not trying to throw blame, but there, you have this really weird scenario when this regulatory landscape in America with American people invested in a governance protocol, the liability wasn't assumed back then. And so in some way, shape, or form, there's a lot more liability now as securitizing Compound, potentially having board members in the United States, having particular liability on certain aspects. And, the SEC has gone after a couple other well-named protocols and going after people, the delegates that voted on potential proposals that would drive growth and drive incentives to that, Uniswap being, I think, the most public one, in which have scared off a lot of the delegates, right? So if there isn't, if there's only risk in voting and there's no financial opportunity and financial incentivization, you kind of get into this weird scenario of like, why would you vote, right? If it's only risk and liability and you're not getting paid to vote, or you're not getting, a return on an investment for holding this token, or potential security down the line. It's not a security as of today that I understand of. Like, why would you vote? So I get it. The financial incentives also need to be able to be there to take on the risks and liability to vote. Uh-oh.
So with 10%, with 10% of the supply, which essentially gives them the supermajority when it comes to voting, what exactly could be voted on in the future?
Well, there's a bunch of risk vectors that may or may not be public. But the most obvious one is collateral, like different collaterals, different markets, different configurations. Like whatever is going to happen, we're going to make sure that it's protected, like users' funds are protected. That's like all the conversations that we're having above all and most is make sure that users' funds are protected at all costs. There is a, there's active negotiations going on right now behind the scenes, which is a little bit to basically be, I don't want to like throw everything out there, but you have everything from brand risk to the comp price token. Brand risk in the scenario is like you basically have a new owner, for lack of a better term, or voting control, majority control of comp now, and they basically run it. They have enough votes to get quorum. They have enough votes to kind of push initiatives, but they also have the liability now, right? So it's a big risk undertaking the running of a protocol and driving that. We've kind of like mathed out and game theoried out the dumping of that comp. Which we don't believe, as the major holder of comp, currently owning like $36 million worth of comp, he would be destroying his own bags if he did anything that was. So we're in a very, very interesting situation here around that, and all of our conversations right now is like, okay, how do we maintain this and come to a resolution where it's you don't have majority control, but also we can start to discuss around a yield bearing situation where there is a stake comp where it has some yield and yield benefits to it.
So there's $2 billion inside of Compound right now.
Mm-hmm.
And you keep on talking about liability. Obviously, I don't think that anybody wants to see Compound lose any sort of market share. And I doubt that Humpy would want to see that. But like in the long term for Compound, like where is it right now? What kind of product is it trying to be? With Aave essentially having committed founders still and really going on a high growth path. Like what's been the kind of like growth story around Compound?
Yeah. So, with the advent of Compound V3, that I wasn't working on that tech. I saw an opportunity to help grow the protocol. We had a bunch of discussions around running grants, and it took about 8 months to gather information from all the delegates to understand what's the growth story for Compound. And I was on the opposite side. I was trying to get Compound to a couple different chains, and it was like a really, really kludgy process, right? Where you had to like jump through these hoops. And so the initial goal was, how does a chain purchase Compound? Like, how do they get enough incentives or enough grants or whatever it needs to be to be able to buy this product, right? Because originally when Compound came in, there was so much inbound. It was the first. It was so much inbound, so much excitement. Over time, you have to move from an inbound strategy to an outbound strategy. So our strategy was always making deals with chains, making deals with collaterals and assets. And thankfully, if you kind of like run the numbers and the help of Gauntlet in the way that Compound V3 was built, a majority of the capital in these lending protocols are institutions and structured products and whales, right? So the institution structured in products and whales are looking just for the most capital efficient, best rates of returns. And the way that Compound V3 is built, it is literally built for that, right? It's more capital efficient. And if you just look at on the surface at percentage points, Aave's downfall is that it's very profitable, and we're generally about 1% cheaper on pretty much every asset, either borrowing or lending. There are some outlier cases with some dumping of incentives that kind of make those things out of line, but the intention that I understand from the conversations I've had, reading the docs and everything, is that it's built for institutions. And we're talking to institutions on how to leverage this. We recently did a deal with OKX. It brought around 70-80 million in TVL to the Arbitrum markets. And, so we're going that direction. Think like crypto.com, Revolut, we're in conversations with, and a bunch of RWAs and institutions that are bringing RWAs on chain in the most capital efficient manner. So our growth story is invest the protocol into chains that we believe will have a 50 to 100 million TVL type of engagement, where on average it's a little under 1% comes back to the market reserves, which you could some way, shape, or form consider revenue, but not really. And so can we make anywhere from $500,000 to a million a year by going to a chain and pushing markets, and then really leaning into the technology, the business development and relationships between institutions and the oncoming RWAs and the tokenization of RWAs, which we have like 8 or 9 different conversations with right now.
Yeah.
And how does are there any thoughts? Because I think that's like kind of Humpy's motive in a way. Like, are there any thoughts of how to make the comp token as a revenue sharing token or something like that?
100%.
I don't know. Is that what's driving like this big move by Humpy? At least from the outside, for someone not that educated about this topic as myself, that's what it seems. It's like he's sitting on a fortune and wants that fortune to work.
Yeah, I mean, that's what we're all doing, right? That's like the most, like we have bags and we want to put them to work and generate yield. Like, I get it. He's not wrong on that aspect. I think, and I don't really driving, assuming malicious intentions is something that I've worked on as I've gotten older and wiser. I try not to assume malice. In some way, shape, or form, he's not wrong, right? I just think how this is being gone about could have been better, and we're working towards that goal. To say specifically, there are 3 or 4 different vendors that we're looking at different staking opportunities, which some of them have big brand names backing them. They've been around in the sphere for 3 years. Like, I think staking and yield will come to fruition within the next year, with or with not Humpy and the gold comp, and like that will happen. It's just finding the best deal, finding the best route, getting everybody on board. Do certain people need to divest? Does this thing become a security, regulatory risk? But I believe that we'll have staking yield by this time next year in some way, shape, or form.
Yeah, and if you look at the kind of broader DeFi landscape, almost every project that came after comp implemented some sort of staking or a VE style system in order to keep tokens locked up. Based on what's being proposed by Humpy, he wants to essentially build a convex style liquid locker that has the same kind of functioning as convex does, where you can either choose to get the yield or you can choose to have the voting power, which convex has through VLCVX and then like CRV CVX. And you have to choose the one, right? You can't have both. And, voting power matters for people who really want it. Other people just want the yield. And this kind of separates a lot of the mercenary capital wave for people who believe in the long-term health and growth of the protocol. I think that it is pretty wild though, that we're that and it's really just a side effect of low valuations at this point. That the OG, you can argue that like OG DeFi 1.0 has been crushed from a valuation perspective to such a low point that it's allowed these type of I don't even call it attacks, but people to come in and buy a significant amount of market share through exchanges on different places to acquire, 5-10% of a given token, which gives them a huge amount of governance voting power. And if we're looking at other protocols, they might be at, I don't want to say at risk, but they might be open to these types of new investors who are coming in and replaying the same playbook that Humpy's been running.
How much of the whole amount of, like, how much of the available amount of comp tokens to vote actually voted also? Because I think that, 10% is actually a lot more than 10%, right? Because not 100% of the tokens actually participate in the vote. So it's actually an even bigger relative part, making what Sam just mentioned to be an even better strategy.
Yeah, I gotta be careful here. In the next 2 days, everything will kind of unwind or get aggressive. And nobody wants aggressive. We want to de-escalate the situation. Let's just say that we have a path on user funds will be safe on that, and Humpy is not wrong. There needs to be some financial incentivization for token holders. If there's no financial incentivization to hold the token or interact with governance, capital has a cost, and people will divest and they'll go to another product, or Eigenlayer and LRTs that are spinning out 20% APR. Like, your capital has a cost, and the VCs and the people that have invested in their fortunes, their time, and their hard work have the capital, and they're going to put it to work. And where they best and so our job is to try to make it lucrative to engage in governance, to vote, and to bring a stabilized situation in which it's win-win for everybody that's involved. What I will say, the protocol makes a little under 25 million a year right now in reserves that's going to reserves, and the conversation is that we're having behind the scenes is what to do with those reserves, right? And should we bring that back to token holders? Should we bring that in a mechanism design in which people are engaged in the community? They either stake for time, rethinking governance, and bringing that. And we are. I was talking earlier today. We are. If you ever seen that little sign of the hero's journey, we're in the abyss right now. We are in the guts, wrenches. Like, look, we knew there were problems, but like this is blatantly apparent now, and we have to transform and revive and fix the situation and grow into something that was better. I think why I got into crypto originally is I used to write financial applications for the U.S. government, and I was like, what the heck is going on here? It's insane. So we are seeing the financial evolution and economic evolution and governance evolution happening in real time, where this is one way not to do it. This is one way not to make a light bulb, and we're going to evolve and iterate and find a better path forward.
I think it's really well said, and maybe a benevolent dictator is what's needed to like right the ship, right? Because
maybe.
Lending is extremely competitive, and if you look at like where Compound is and some of its competitors are, there's a lot of ground that can be made up in trying to acquire new TVL, go out to new chains, and this reminds me a lot of what happens in like TradFi world, right? Like,
yeah,
firms that kind of rest on their haunches and sit back typically get acquired, sometimes through hostile means. And it isn't always pretty, but sometimes it can lead to a reinvigoration of that market and really spur a comeback in the asset that's being revitalized.
Yeah, there's a non-zero chance that there's some sort of M&A opportunity here. Like, and the discussions happened. Because
what's an M&A? I apologize. What's an M&A?
Merger and acquisition.
Okay.
Yeah.
Mm-hmm.
So just figuring out like, you know, a benevolent dictator or somebody, you know, the future is like, you know, how do I say this? Software is eating the world. Crypto is software. Crypto will eventually eat TradeFi and RWA assets. But the cost of capital to do that and to take on that vertical might be more than what Compound currently has. And so there is an opportunity in the future, potentially M&A, benevolent dictator. These are all possibilities. And you know, what I will say is that we're going to be around here for a long time. And whatever happens after this fact, you know, we're gonna help Compound grow, and I think things will de-escalate. I think terms will be met and a negotiation will happen, because that's what's in the best interest for everybody. Unless somebody goes, you know, self-destructive mode and wants to see the whole world burn down, but you know, they're gonna have to burn $35 million worth of their bags to do it, and I don't think they want to do that.
Yeah, there's a lot of parallels between how Convex came on in the Curve ecosystem several years back, where now they have over 50% of all the CRV in their liquid locker, which essentially gives them a huge amount of governance power at Curve. C2 and Winthrop are essentially benevolent dictators. They can be outvoted. So if the gold token does become like the de facto voting token for comp in the future, hopefully there's enough holders across many different places that are able to take it. I did want to bring up a chart just so everyone can see the kind of change in distributions of voting power before and after this. So this is a chart that was put out by Chaos Labs. And so this is the current voters chart. So there's 1.5 million, a little over 1.5 million comp that's in the comptroller. That is currently what's being voted on for 500,000 to be transferred to the Golden Boys multisig. After that, Binance has 500,000 comp. Robinhood has almost 500,000, about 400,000 comp. Compound USDC V3 has some. Then A16Z with around 250,000. Robinhood has some more. OKX, Genesis, Bybit, and the list goes on. Let me just show the chart afterwards. So this is what that additional 500,000 comp would add on to into the liquid locker. It would give them an incredible amount, and it would take essentially Binance, Robinhood, A16Z, OKX, Genesis, Bybit would all have to vote together using probably customer funds to outvote anything that was happening.
There's way too much liability for them to do that, right?
Exactly.
Yeah. And we've reached out to these guys. Some of these guys on this chart right here. We're in conversations with them on, and you have this weird scenario is like, is it on them to protect customer funds? Like if there's some sort of contagion event, like whose responsibility is that, right?
Mm-hmm.
Is it on Binance to step in and say, okay, in this case where, you know, $100 million worth of value or $50 million worth of value could be lost, is it on them to do that? Currently, as precedents, they're not going to, and I'm not in conversations with Binance, but a couple of these other guys, they say if we have to, we will, but essentially right now the answer is no.
Yeah, I did want to bring up one other thing, which may be the solution to all this, and that's
curious. So curious.
Unfortunately, it can't help Compound now because it's too late and the vote is already passed. But for future DAO votes, you can always institute a poison pill.
Yeah.
So ENS was the first to bring this up. They introduced this like voting address called veto.ensdao.eth, and they put a sizable amount of tokens in, which would almost give them a super majority in pretty much every single vote. And what the vote veto.ensdao.eth would do would just veto everything. So it would vote no. So in case of any sort of actor like Humpy coming in, A few key people would be able to essentially shut down anything to protect the overall DAO health and structure as they saw it in the current form and narrative.
Poison pill. I think there's 3 other kind of things that we're already discussing. Lido has a 2-term phased approach where you can do yes and no on phase 1 and then no votes on phase 2 in case. And so, this was like an hour, from my understanding, it's an hour before the vote ended. This was going to be a no vote, and then it flipped. So having a phased approach of votes, having another thing where you can only stream, like, you shouldn't be able to take 1/3 of the treasury, of the comp treasury in a single vote, making it so that you're only able to stream out the potential treasury. And it could be in size, it could be, 100K a day, but still there would be time in that to 25 days for 25 million or whatever. My math is off, 1,000 days. So there would be some scenario in which you need to like kind of modularize that. It was a phased approach. There was the stream, and there was one other perspective that, I forget the other one, but yeah, poison pill, more governance, and there's a lot of liability in some of the poison pill methodology, right? Because if you have a poison pill and you have a multi-sig, then essentially what ends up happening is they're taking on the liability and they're saying, okay, in normal situations, we'll pass governance, but in this situation, we won't. So could there be liability of the multi-sig poison pill owners on not doing what they were saying they were going to do, and could they therefore then be liable after? It's all liability and regulatory, right? We want code as law as most of the time, except in these like really outlandish scenarios. And like, kudos to him, man. There's a smart dude behind this. Like let's not bullshit. He figured out ways to play the governance to its fullest, and then he played the game. So now, okay, you win. Don't burn it all down. Let's figure out how to cool, bouncer hack, white hack bounty. We'll figure out something.
I think this is a bone that gets thrown to the DAO haters that say there is no such thing as an actual DAO. You can't have true decentralization. You have to have some sort of centralized entity at someone at the end who can vote yes or no in these kind of extreme circumstances. I know that we have had several guests on who question the ability of DAOs long-term to function just because of issues like this. Like, if you're going to have high volatility assets, which are not shares in a company, but give voting rights, the valuations of that might hit a point where it becomes economically feasible to perform some sort of RFV, is potentially what happening here. This is like a RFV play, you could argue, or a host of other types of social governance attacks or economic attacks that could potentially put the overall health of a really well functioning project at risk. So.
Yeah, I get it. And when Alpha Growth got signed up to do the compound growth program, all of these issues got brought up, and we were I think we're 2-3 months in. We're 3 months in at the end of this month onto this engagement, and we were really concentrating on the growth. Governance was in there. We deprioritized governance. We deprioritized the liquid staking idea, the delta neutral vaults that we're looking to put up, and we were focusing on, hey, we grew about 140 million TVL, 130, 140 million TVL in the last 3 months. But yeah, we admittedly we were focused on that versus how do we figure out to protect all the different governance aspects. There's lots of stories in here.
Yeah.
I don't know what to share or not
I
share.
saw something about a time lock. Sam, can you pull up this tweet I've sent in the chat?
Yeah.
It's something about one proposal that is now up in an attempt to kind of control it. Can you maybe press on that screen?
This is the poison pill.
It's like a different style than the one you guys have mentioned, no? You and Sam just.
Yeah, so there's a poison pill to protect user funds.
So the idea here is that even if the comp is transferred, you insert a poison pill, which could shut down any malicious. Like somebody wants to create a new market that is wild. I think that Humpy's sitting on a lot of KNC, for example. Let's say he wants to
KNC? What's KNC?
Kyber network.
Kyber network. Okay.
Yeah. So like the issue, like lending is a crazy world because you only really, there's really only demand for like the top tokens, ETH, BTC, maybe a couple of like big ERC20 tokens, and that's it. Everything else is really risky, and you take on a ton of risk by adding new markets in, especially when
because of the volatility of the price, you mean, right?
Volatility of the price, like the oracles may not be the best, liquidity may not be the best. If you have to liquidate, there could be liquidation issues. Like lending is really hard at the end of the day, especially permissionless lending. It's not an easy thing to set up. And from what I've heard from other projects, there's just not much demand outside of ETH BTC and a few other assets. And we can see this at Compound. Compound has like USDC, Tether, Ether, and do you guys have Bitcoin? Yeah.
I would say that most of the growth in the market, if you look across all the lending protocols right now, are around ETH, LSTs, LRTs in those loops. Most of the ETH is captured in structured products. We do have a bunch of Bitcoin, mostly as collateral. There's not really a way to lend Bitcoin and get Bitcoin on Bitcoin. That's something that we talked about. I think, like you hit the nail on the head. The after you go after like the top 15 assets, you're going further, and like there's it's a Pareto's principle. There's like an immediate drop off of the risk curve of these different things, and the Nakamoto coefficient, and how many holders that they have, and how many whales, and price manipulation. So it's hard, right? It's hard to get these certain collaterals on there. We've been leaning into LSTs and LRTs because of that's where the growth is currently within the Ethereum. There's also demand from chains to have yield-bearing tokens, such as like Athena, the LSTs, the LRTs. And there's a huge demand in the upcoming like iGun situation where all of these LRTs are going to need to start producing a bunch of yield. So we're having a bunch of conversations around that.
But there's a lot of risk that comes with that. Like you only have to look at the Renzo depeg that happened like 6 weeks ago.
Yep.
Where on some networks Renzo went 80% off the peg. Gearbox lost half of its TVL just in that event. I think Morpho had some bad debt that accrued as well too. So anytime you move away from highly liquid assets to less liquid assets, especially ones that don't have any withdrawal mechanism and liquidity is lacking, there's way more risk that gets introduced. And that's kind of what you have to run through with these with these lending markets, is that people need to know that they're going to be able to deposit funds. The markets will stay good, the oracles will stay good, and these outlier events, if they do happen, won't affect their lending debt at the end of the day.
Yeah, we decided to not list Renzo in that scenario after the DPEG. They had to get redemptions back. We were in conversations with them since February or March, right? The original idea to prevent against that was to create an isolated LRT market. So while there would be good, even better yield than, like, say, the USD, the Ethereum mainnet ETH market, we were going to isolate that risk. And then it was decided upon that because of the usage and everything, that we would add the LRTs back into the main Ethereum market. But when these conversations are happening, can we isolate the risk with higher risk collaterals? Maybe there's more yield on the base asset on Compound V3. We're having these conversations all the time and evaluating that. I think there's kind of like core contagions within every chain, or every like isolated ecosystem. So if we're isolating risk, because of the way that compound V3, it doesn't do cross-chain risk. Every market is isolated within itself. So we can take some assumptions on there. Like if you're, pro optimism, like we can list the OP token on optimism because you're already on optimism. And then that in and of itself, if you're in that market and you want that higher yield on optimism, then the OP token and everything, all the collateral assets in there, you're inherently being more risk on versus Ethereum mainnet. And that's kind of how we look at these different scenarios. As we go to more L2s, there's more yield, but there's more risk in these collaterals. And then talking about how to isolate the different collaterals.
Yeah. Well, I appreciate the candor that you've brought today. And
Trying to, man. This is a crazy scenario. I had 7 kids at my house playing, and my wife's like, "What are you doing?" I'm like, "This thing happened." Like, I was like chilling out, taking a day off, and got 3 phone calls in the span of like 10 minutes. I'm like, "What's going on?" So
it's always on the weekend, isn't it?
Right. Yeah. But thanks for your time. I'll bounce. I got to go back and figure out how to unwind this now.
Yeah.
Thanks a lot for coming, man. It was really informative.
Cool.
I think it was a very important stream, and appreciate you coming.
Appreciate your time.
Yeah, thank you, Bryan. And thank you everybody at home for tuning in. Just to recap, you can find Leviathan News at Leviathan_news on Twitter and Telegram. And make sure to check out our sponsor Yield Nest at yieldnest.finance. They have
sponsors for the first time. Good job, man. Good job.
Dio, longtime listener and guest as well too, is on that team as one of the founders, and we really like the product. It is going to be, we think, the most adaptive and dynamic AVS capture in the market, and it's definitely something that we all love at Leviathan and are using ourselves. So go now and check out their YN ETH product, where you can restake and get access to a bunch of different categories. It's going to be going liquid soon. And thanks for tuning in.
Shout out to Deo and Yield Nest guys for the first sponsorship. And hopefully we're gonna have some other sponsors in the next few months as well. I think for us it's a very important move as well. And let's see how it goes. Let's learn